lot of people don't know how to successfully use trust. And so let's dive a bit more into this. You know,
Yeah.
trust was something that was predominantly used by sort of very wealthy people, and it was something that was not provided access to the common men. And so we can see that now on an ongoing basis, it's a vehicle that a lot of people are getting used to, more not just from an asset protection perspective, but also from a tax planning perspective. So let's dive a bit deeper into this as to how many types of trusts are there, and which is the trust that we should focus most on when we are talking about property.
Yes, sure. So trust, in essence, trust is a legal vehicle through which a third party, or it is trustee, holds and directs assets on behalf of beneficiaries. Okay, the key elements of the trust arrangements are settler who creates the trust. Okay, usually in our situation, accountants create the trust, and the trustee who administers the trust, and the fund where the income is received, and the beneficiaries who benefits from that trust or income received from the assets. So one of the key features of many trusts is that there's separate ownership from the assets and the control, which can have both tax and asset protection implication, as you mentioned there. So basically, there are different kind of trusts, predominantly used in a smaller scale business or a small investment or a small wealth creation vehicle. It's discretionary trust, which is usually a family trust, and families they combine their pool their money in a trust, or the finances in a trust, buy property in the trust, and they have a discretion to use trust income. The property income is coming in the trust, and then when there's a time to distribute that income, they have a discretion and flexibility how they distribute that income to different beneficiaries. Okay, in a family environment, beneficiaries are husband and wife and kids. Kids under 18, you cannot distribute any income to under 18, for example. This is common in any trust anyway. You can, but yeah, there are higher tax implications. You have your parents, adult children, siblings, you can distribute some income. So it becomes a tax effective vehicle at the same time, and it keeps the asset within the family group as well, which is the protection at the same time. If there's any legal claim in your business or anything else, you're working, for example, as an architect or doctors, usually they are very prone to legal claims. They employ these kind of strategies, especially trust structures, because it gives them that protection. You're safeguarding your family asset or wealth while you making profit safely. So that's the idea behind the trust. And discretionary trust is one of the very common trust people use to buy properties or invest in different investments. Sure. Not just property maybe, but yeah, the other kind of trust.
When you talk about discretionary trusts, I've seen people placing bucket companies within their discretionary trust as well, so that there are profits which you can't subsequently distribute to your family members, or they're hitting that threshold. You would see them holding that profits in those bucket companies to save more taxes in the future as well.
That's true.
Talk to us a bit about that as well.
Yeah, as the name implies, bucket company means you can keep bucketing your money in there. Yeah, so in the trust, like unlike you can retain profits in the company, but in the trust you cannot retain any profits. So by law, you have to distribute those profits to the beneficiaries every year and every 12 months. So sometimes you are not able to distribute, or you don't want to distribute certain income to a higher income earner, because both husband and wife, they are on a employment where they're earning high tax. They are on higher marginal tax rate. The income is high enough to pay lots of tax. So if you distribute some more income, they pay extra tax. Instead, you use additional company, which is called bucket company, where you can distribute that income to the company, where you pay 26% tax and keep it there for a while. For future, you can take that money out slowly and recoup some taxes back later on. When one of the family member has lower income for some reason, for family planning or other things, study family planning, you have reduction in income, you can use that company to pay a little bit income and recoup some taxes there. So yeah, it's not that you're not paying tax, you're paying little tax. Or when you don't have to pay more tax, then why would you pay more tax?
And can that bucket company further loan out that money to other projects or other companies or other trusts that you have in order to manage your books a lot better?
Yeah, it is possible to use that company as a different vehicle, as an investment vehicle as well. But yeah, you have to structure in a manner that you can utilize that money to invest further or use that in a different scenarios. Yeah.